So as we wait for them, remember when it comes to group accounts, consolidation basically, as we've said before, the most important thing is for us to define the level of control, the level of influence. Once you have defined the level of control, you are able to know that this company to us is a subsidiary. This company to us is an associate, or is basically a mere investment. It will be very easy for you to know the consolidation procedures you'll be following. Which IFRSs shall be applicable in these particular situations? Great. So a quick reminder of what we did in our previous sessions. If you have company A, company A, we are told, has bought 80% of company B, 80% of company B, 80% of company B, and then company B has gone ahead and bought 60% of company C, 60% of company C. So could you kindly, as a way of a quick recap, could you kindly tell me, company B will be which type of a company to A, and the company C will be which type of a company to A? Right? Remember, you are the ones now who are giving me the answer. B, automatically B, you should be able to pick what B is to us A. Is it a subsidiary? Is it an associate? Is it a joint venture? What is it to us?
B is a subsidiary of A.
B is a subsidiary, simply because we can see that B, that we have got more than 50% of what here? More than 50% of B. So in this case here, B, we have more than 50, this is more than 50%. So automatically, B becomes a subsidiary because of significant shareholding. More than 50% means that automatically we are in charge of B. When it comes, for example, to us putting directorships in B, will be the ones in this case will be having majority number of directors in B. So straight away B becomes our subsidiary. How about C? C automatically also, C, without no doubt, without no question, C becomes a subsidiary of B, a subsidiary of B. How about C to A? C to A. Look at the effective shareholding. Look at the effective shareholding of A in C, of A in C. So effective shareholding of A in C, remember A has got 80% of B, and B has gone ahead to buy 60% of C. So it means that effectively A has 80% of the 60%. So 80% of 60% gives us what here? Gives us 48%. Now, could you be kind to me, tell me, what do you think will A do as regards what here? As regards C? Will it account for C as if C is its subsidiary? Or shall it take C to be an associate? Great, please give me answers, and remember, it doesn't matter whether you get it wrong, so long as the most important thing is to speak. What do you think of C to A? C to A, I can see Robert tells us associate. Thank you very much, Robert, for attending. I saw yesterday you were not very sure of attending today's session, and I can see you are the first one to check in. That is so good. Great. Remember our thresholds, Our thresholds are like this. We have 20%, we have 50%, and of course we have got 100% there. Anything less than 20% is basically a mere investment. When we have shareholding in a company which is less than 20%, that is a mere investment, and the mere investments can never be consolidated. No. Now, between 20% and 50%, Between 20% and 50%, that is 20 point maybe 001 all the way to 49.99. In between here, we'll have what we call an associate. An associate. Now listen and listen to me very well. What if we go to a company, for example, company D, and they purchase exactly 50% of D? If we go to company D and they purchase 50% of company D, of course, company D will fall under what we shall be calling joint arrangements. Joint, where in this case here we are holding onto our steering wheel, two of us. We are running this particular company jointly, 50%. Mr. 50% is a half-half. Joint arrangement, of which we shall be seeing what joint arrangements stand for. And then, of course, we have here 50%, or rather 50%, slightly more than 50%, all the way to 100%. This becomes what here? A subsidiary. This becomes a subsidiary. But now listen, there are exceptions. According to IFRS 10, there are those exceptions that we must always remember. The power of what we call control. The power of what we call control. The power of what we call control. That we could be having, for example, we could be having company A having like 42% of C. 42% of C. If we have company A having 42% of company C, you will very comfortably tell us that company C is an associate, very comfortably. But what if, for example, you are told that this other 58% of the shares, 58% of the shares are held by 100 shareholders. 100 shareholders, there's too many. For example, they have this 58% equally distributed between those 100 shareholders. And then we have you as A, who has this 42%, all of it as one investor. Automatically, you will have a say. You will have a say. So if that is the case with these kind of exceptions here, where perhaps you are told, fine, you have a smaller percentage, 42%, but there is a memorandum where you sat down in an AGM and they say that A is the one to run C. That A has been given an opportunity, despite having a small percentage, has been given an opportunity to go and appoint, for example, all directors of C. Remember, ladies and gentlemen, nowadays control is not defined just by a mere number. No, it is both quantitative and qualitative. And that is why when you go to a client tells you that we have made these particular investments like that. This is Arrow Consultants. They have gone to a client, for example, called company A, tells you we have made these kind of investments. You need to ask yourself, the first thing, what is the shareholding? Maybe 80%. Do you have any agreements with the other parties, with the other investors? For example, they'll tell you that, fine, we have got 80% of C, 80% of C. But C happens to be a hostel, and we do not have managerial expertise to run this hostel. So what we have done, the minority shares, the ones we are calling NCI, the minority shareholders, we've given the powers, because perhaps those are doctors, we've given them the powers fully to run the hostel on our behalf. So automatically, C, even if we have got a majority shareholding, C will not be under your control. C will not be your subsidiary. You can't consolidate. And that is why, if you have been an auditor, anytime you go to audit a group of companies, when you are looking for what we call the components, subsidiaries, associates, etc., you need a file of control. You need to know exactly who is controlling what. Otherwise, you will end up consolidating financial performance of a company to the group where you are not supposed to do that. So control is a key, it's a major thing. After you realize control, sorry, if I was to go back to our question here before I go to what I want us to study today, our question was A, we have B, and then we have got C. So A has got 80% of B, and B, a company that we are in control of, has gone ahead to procure 60% of C. Now listen, even if our effective shareholding as A is 48%, simply by the fact that we have control of B, and the B has control of what here? C. B has control of C. Automatically, even if this shareholding falls below 50%, automatically C becomes our subsidiary. Listen, subsidiaries of our subsidiaries. C is a subsidiary of our subsidiary. C, because of the 60%, is a subsidiary of our subsidiary. It doesn't matter our effective shareholding. If it is a subsidiary of our subsidiary, what we call a sub-subsidiary, automatically this company C becomes our subsidiary, and we have to consolidate our financial statements like that. So unless there is a question, please allow me to look at our today's work, and I will start by sharing our screen. Madam Emily, welcome, and I hope you have a good morning.
Thank you.
So today I want us to look at something very interesting. If you're writing notes there, I would want you to write there a title called PAPS. PAPS is a very special working for anybody who is doing consolidation. PAPS. PAPS is an acronym which stands for Provisions for Unrealized Profits. Provisions for unrealized profits. Provisions for unrealized profits. Provisions for unrealized profits. Provisions for unrealized what here? Profits. In this case here, we shall be capturing these using the famous PAPS. Now, ladies and gentlemen, listen. For us here, what you're supposed to know is that these two companies that are related, company A and B, perhaps we have A having 80% of B. At the end of the day, we will be told that A, for example, A sells goods to B. You'll be told that A, for example, sells goods to B worth $10,000 US. $10,000 US. Now, ladies and gentlemen, remember, such a sale from the eyes of the group, this sale is called an intra sale. This sale is called an intra sale. Intra for internal. Intra for what here? For internal. Listen, all internal sales are normally what? Fictitious. All internal sales, if you're writing your notes, all internal sales are normally what here? Fake. They're fake. Like I gave you a very good example in our last class. From the family perspective, here we are. I happen to be owning a particular, for example, shop which sells what here? Sells shoes. And then my son comes, my own son comes and asks for some what here? For some shoes. Asks for some shoes. Now tell me, will I really ask for any money from my son? Will I ask for any money from my son? No. That will be an internal what here? An internal sale. When I look at this from the perspective of a family, that particular sale will be what here? Will be fake. If, for example, it was someone else who was in that particular shop when my son came checking in, and that particular person, perhaps an employee of mine, that particular person went ahead and sold the shoes to my son. When I go back home, for sure, I'll have to refund that money to my son. Why? Because that sale is what here? Is fake. So remember, intra sales do not apply, for example, to associates. An associate is like a distant relative. An associate is like a cousin. If I go ahead, for example, from my shoes company, giving shoes to all my relatives, then for sure I will not be in business. So if it's associates, mere investments, their sales can never be cancelled. Those are not internal sales. I'm repeating again that internal sales only happen to be the sales between a parent company and its subsidiaries. A parent company and its subsidiaries. So if I were you and I'm writing notes, I would have said that this concept of intra-sales, internal sales, is only applicable whenever we have sales happening between relatives. And relatives in our case are parents and subsidiaries. Parents and subsidiaries. Now listen. We have here, A, we are told sells goods to be worth $10,000. And then we are told something very interesting, that A's profit margin, 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 A's profit margin is 20%. A's profit margin is 20%. A's profit margin is 20%. Very, very important that when we sold these goods here to B, we recognized a profit of 20%. And then lastly, the third requirement that will be given, the third note will be given here. Someone will come and tell you that by the end of the year, by the end of the year, B had not sold 40% of the intra-sales, 40% of the intra-sales, 40% of the intra-sales, 40% of the intra-sales. We are told here three things. That B, which is our relative. Why am I saying it's our relative? Because we own 80% of it. We own 80% of it. It's our subsidiary. And we are told here that A went ahead to sell goods to it worth 10,000. And because these are goods sold within the group, we refer to them as what here? Intra-sales. And then we are told something very important, that A's profit margin is 20%. 20%. Then we are told that by the end of this reporting year, B had not sold 40% of the intra-sales, meaning that B effectively had sold 60%. But we have what we call unsold intra-sales of 40%. So we are required to calculate PAPs. The moment we understand this, we have understood the entire concept of today's class. So if we understand this very well, then that is it. That is it. So we are required here to calculate the PAPs. PAPs, I would want to again mention this for the sake of us understanding this better. PAPs in full stands for what? Provisions for unrealized profits. Provisions for unrealized profits. It is applicable whenever we have internal sales, where we have intra-company trading, companies that are related, trading, doing business between themselves. So solution, how do we compute these PAPs? What is the formula for getting these PAPs? To get these PAPs, the formula that I would want you to put down, is quite an interesting formula. To get PAPs, we normally take the remaining. Intra-sales, or what we can call the unsold intra-sales. The unsold intra-sales times profit margin. times profit margin. We normally take unsold, the unsold. We normally take the unsold. We normally take the unsold intra sales times profit what here? Profit margin times profit margin. So anytime they talk about PAPs, PAPs is provision for unrealized profits. How do we get these PAPs? We take the unsold intra sales times profit margin. So as a consultant from Arrow, when I go in this case here checking the file, of course, in this case here that these people have given to me, I would want to know whether the related companies were able to trade between themselves. And if they were able to trade between themselves, what I'll be interested in is not even the total intra sales. What I'll be interested in will be the unsold. Like now here, in total, we sold how many goods? Goods worth 10,000. But by the end of the period, we are lucky. This company that we sold goods to had been able to dispose of, had been able to sell 60%. We are told here by the end of the year, B had not sold 40% of the intra sales. So 60% sold, 40% not sold. So in this case here, the unsold intra sales will be 40% of the 10,000. This is my unsold intra sales. The unsold intra sales times the profit margin. Fortunately, they have given me the profit margin. They told me that A's profit margin is 20%. A's profit margin is 20%. So could you kindly give me this figure? So what you do using your calculator or even Excel, you'll take here 0.4 times 10,000 times 0.2. 20% is the same as 0.2. 40% is the same as 0.4. So kindly give me this figure. Kindly give me this figure. Kindly give me this figure. Yes. So we have here 40% of 10,000. That is 4,000. 4,000 times 20%. That gives me how much? I'm waiting to get the figure from you. You know, when you give me figures, I'm able to know. Robert gives me a figure of 800. Can someone else, in this case here, back up Robert's figure? Yes. Thank you very much. 800. Thank you very much. 800. 800. Now, listen and listen to me very well. Ladies and gentlemen, remember IAS 2, stocks, inventory. Inventories should never have profits in them. It will be very bad as a group to have some stock items which are lying within the group, which we are quoting at a profit, and yet we are not so sure that we shall be able to sell them in the future. I mean, costs or rather inventory should be held at either cost or net realizable value, the lower of the cost we incurred to procure them, ladies and gentlemen, or the net realizable value. We don't want to go into that particular standard. No. For now, the thing that you're supposed to know about group accounting, for you to be able to say that you are competent in terms of group accounting, when you get PAPs, when you get these PAPs should be added. So in this case here, add, when you get the accounting entries, add PAPs back to the cost of sales, add PAPs to cost of sales, and then you less it from less PAPs from the group inventory. Reason being, the group inventory is overstated by that profit. Is overstated by the profit. I would want to repeat this again. When I get my PAPs, what am I supposed to do? I'm supposed to add PAPs to cost of sales. You don't want to even use this language of debit, the general no. You just go ahead and add PAPs to cost of sales. And then you less PAPs from where? From inventory. Now listen, how do we get our cost of sales in the income statement? To get cost of sales, ladies and gentlemen, we normally take the opening inventory. There is something I would, don't write this, don't write this. This is just by the way. We normally take opening inventory. Opening inventory, we have a figure, for example, of 10, just a hypothetical figure. And then we'll come and add what here? We add purchases. If it's just a merchandise farm, we add purchases. Perhaps in the year we purchase 20 bob. And then we'll come and less closing. We less closing inventory. We less closing inventory of, for example, 5. So if you come and take, this is 30 minus 5, that gives us 25. This is what we call the cost of sales. To get cost of sales, we normally take opening stock plus purchases minus closing inventory. Now listen, what if in this case here later on, we realize that this inventory, closing inventory, was overstated? When you overstate closing inventory, when this closing inventory figure is more, assuming you overstate it by 2, assuming the overstatement is 2, assuming that in this case here, this is overstated by 2. Perhaps in this case here, we were supposed to put like say 7 there. Assuming we just take it a little bit higher, what is going to happen to our cost of sale? Our cost of sale will go down. Our cost of sale will go down. I'm repeating this, that when you overstate your inventory, your cost of sales will be understated. When you overstate your closing inventory, your cost of sale will be done what will be understated. Remember ourselves, we have overstated our closing inventory with that profit, with the PAPs. Our closing inventory is overstated. And when you overstate your closing inventory, you have said that the cost of sales will be understated. And that is why to make good, we are adding, we are increasing the cost of sale. We are increasing so add the PAPs to cost of sales, and then you less PAPs from what here? From inventory. I hope you have been able to take that down. Is there any question regarding this little introduction on PAPs? Is there anybody who has any question? Please feel free to unmute yourselves and of course talk to us.
Joshua, I'm just curious about the journal entry you're going to pass if you realize that a group has PAPs in their inventory.
Mm-hmm.
Like now, if a customer you're consulting for
Mm-hmm.
Realizes during their closing that they have overstated inventory, so you need to pass a journal for that.
Mm-hmm.
In Arrow.
In Arrow, very good.
Okay, like hypothetically, what journal would you pass?
The general entry for a year straight away, like I've said here, you will come and debit your cost of what year? You debit your cost of sales. You debit your cost of sales. Debiting your cost of sales means what? You are increasing the cost of sales. And then we'll come and credit just the inventory in your income statement. In your income statement, like that. So when you credit inventory, what does that mean? You are reducing the inventory. So I hope Janet have answered your question.
Yeah. But you credit the inventory in the balance sheet, right?
Both. You remember, the moment you credit inventory, automatically the inventory, we have inventory in the income statement when you are getting cost of sales, right?
Yeah.
Yeah, and the same inventory which you have credited will automatically also have an impact in the balance sheet.
Okay.
Yes. Okay,
all right.
Great. Now, here we are, example 2. So example 2, as you're doing your analysis, you will come and be told here that we have these two companies which are related. We have A and B. You have been told that B is our subsidiary. And then you'll be told that, for example, A again sold goods, worth how much here? This time round, a stock of $20,000, right? And then they'll come and tell you that A charges a markup of 20%. A markup of 20%. right? And then we'll be told that all these goods had not been sold, all not sold by the end of the reporting period. They are not sold. By the end of the reporting period, they are not sold. So we are required to calculate the PAPs. We are required here to calculate the PAPs. Remember, I've given you a formula of PAPs, and I would want to give you exactly 1 minute. We see whether you'll be able to pull this down correctly. But remember the way of learning, if you want to learn best, be yourself. Always give answers in whichever way. It doesn't matter whether you're wrong or correct, because it's supposed to be a communal thing. What we call the we learn. At the end of the day, we want to learn. So it doesn't matter whether you're going to get it wrong or correct. The most important thing, contribute. Give us your approach. Janet has given us a figure of 4,000. Thank you very much, Janet. And by the way, Janet is one of Arrow's consultants that we have around. So Janet is going to play a very important role in our case in terms of group accounting. After I do my computations, practical like this, on the board or in Excel, we expect straight away now Janet is getting a new role in this class. Janet to go and put these figures, to plug the figures in Arrow, and then she should be able to advise us maybe in our subsequent classes whether she got the same answers like the ones we got in class. I hope Janet will not be asking for too much. Do you have that platform?
Where I can, sorry, just come again, sorry.
Okay, for example, if I've done like, say a question, I've done a consolidated statement of financial position. I've given you an example here. And then after the class, you go and plug in the figures in Arrow software.
Yeah.
And then we compare answers. You talk to us in the following class whether you got the same answers or different.
Yeah, so I think what I'm trying to do as we learn is to conceptualize if we can do this in Arrow, either through journals or it's automatically. I'm not very sure, but I'll check.
You'll check.
Yes.
We would want the automated system, not even journal style.
Great. That's a great suggestion. Great approach.
Okay, great. Thank you. So Janet says 4,000. I've not gotten any answer from any other student. Sorry for calling you students. But we are learning, all of us. We're learning, all of us.
I get the same figure.
You got the same figure. Oh, let's see. But you see, there is something a little bit different. This person has used the word what here? Markup. Markup is not the same as margin. Now listen. Listen. To get PAPs, how do we get PAPs here? We take the unsold inventory or unsold stock, intra-sales, the unsold intra-sales, the unsold intra-sales, the unsold intra-sales, times, ladies and gentlemen, times profit margin, times profit margin, times profit margin. Now listen here. How do we get our profit margin? To get profit margin, there is a simple formula that we use. To get profit margin is a representation of our profit vis-a-vis our sales amount. So profit margin is profit all over sales times 100 if you wish. Right? So anytime they want us to give them profit margin, we'll always be thinking about this. But how about profit markup? To get profit markup, we normally take profit all over cost of sales. Please write this. This is very important for us. Please write this. To get profit markup, we normally take profit all over cost of sales. Profit all over cost of sales. Profit all over cost of sales times 100 if you wish. So meaning that profit margin and the profit markup they're not the same. Simply the differentiating feature is that for markup, down here we have cost of sales, And here we have what here? We have sales. But now, ladies and gentlemen, there is something that I would want you to understand. There is something that I would want you to understand. How do we get our sales figure? How do we get our sales figure? To get our sales figure, we normally take cost of sales plus profit. This is important. If I were you, I would have written this like yesterday and highlighted. You highlight this. Sales equals cost of sales plus profit. Plus profit. Right. So meaning that this profit margin, we can rewrite this again. We can write this again, profit margin, to be profit. Instead of using sales here, we use cost of sales plus what here, somebody? Plus profit. Because this equals sales. Cost of sales plus what here? Plus profit. Cost of sales plus profit equals sales. I don't want to trouble you with so much. No, I would want us to understand this thing once and for all. Don't even remember this. This is important, but just in theory. But in practice, this is how we do it. In practice, if somebody tells you that the profit markup, if somebody tells you, sorry, I have to change my battery. So I hope now we are okay. Great. I can see myself there. Great. So if somebody gives you profit markup, of say 1/5, profit markup of say 1/5, in consolidation, we don't use profit markups. In consolidation, I always make use of profit margin to calculate PAPs. So meaning that whenever I see the profit markup, I need to know how to change the markup to margin. So easy. My profit margin has got always a bigger denominator. I'm repeating again. Profit margin has a bigger denominator. Remember that this is my profit now. This is my profit. So this automatically becomes, because it's markup, this automatically becomes the cost of sale. But what I'm saying, I even don't want to go to that. My profit margin will always have a bigger denominator. So what I'll do to make my denominator bigger, I'll come and talk of 1/5 plus 1. Because this one profit, to take it down. Because you have just said here that profit margin is cost of sales plus the profit. So this becomes a sixth, 1/6. Now, listen before I ask you whether you have even understood this very well. If somebody tells me that the profit markup is 20/100, could you kindly give me the profit margin? Just try. Because in consolidation, in group accounting, we don't make use of the markup. In group accounting, we always make use of profit margin. So if somebody gives me profit markup of 20/100, my profit margin will be 20/what?
120.
20/120, yes. So we'll take here 20. There is some time back that somebody told me that it will be 20/101. I tried to figure out why 101. I remembered very fast that it is because the first example had 1 at the top. No. You know what is at the top here? 20 is my profit. So then the denominator here will be 100 plus 2. So it will be 20/120 like that. 20/120. So allow me to repeat something here, ladies and gentlemen. The last question for you, if you're given here, for example, profit margin, say of 20, say 30/100. And then somebody, just out of curiosity, somebody wants you to ascertain the profit markup. Could you kindly help us get this profit markup? just to help us get this profit markup. Help us to get this profit markup. Remember, you've got two ways of talking to us. Either you unmute yourself and talk to us, or even in the chat room, just chat there without fearing anything. Yeah. Anybody who has a suggestion, somebody who has a suggestion here. Remember, they have given us here a profit margin of 30 over 100. But now this time round, just somebody wants you to get profit markup. So the profit markup automatically will be 30. Remember, markup, or rather margin, has a bigger denominator. So if I'm going to mark up, I'm scaling things down. If I'm going to mark up, I'm deducting. So if I'm deducting, this will be 30 over 70. 30 over 70. 30 over 70. 30 over 70. Now, my great students, here we are. They have given us a nice question. They have told us that A has sold to B goods worth 20,000. The intra-sales is 20,000. And all these units here still remain in our inventory. They are not sold at all. And then what this person has done, he has given me a profit markup of 20%. So, hey, the first thing that I will do, once I see this markup thing as a consultant, I'll tell them, no, in group consolidations, we don't use markup. The first thing that I expect you great people to do is to change the markup to margin. So change this, change to margin, change to margin, change to profit margin. And then very fast, I'll remember that the margin has a bigger denominator. The margin has a bigger denominator. Remember, when you see 20%, this is the same as 20 over what? 100. 20 over 100. So when you see markup 20 over 100, then the margin, my grade students here will be 20 out of what here? Out of 120. 20 out of 120. What have I done? Margin. I've simply added. Because margin will go up. Margin in the denominator will always be bigger. Remember, numerators are normally the same. Numerators are the same. So now once I have this, I'll come and remember my formula. My formula is quite easy. We have our POPs. POPs in this case, straight away, POPs will be equal to the unsold. The unsold intra-sales times profit margin. So the unsold intra-sales, the entire intra-sales had not been sold, times 20 over 120. So could you kindly give me this figure? 20,000 times 20 over 120. Could you kindly give me this figure? $20,000 times 20 over 120. Saul must have forgotten our meeting. Today, Saul has come in very late. I hope you're okay.
Sorry.
Okay, great. So can somebody give me this figure? 20,000 times 20 over 120 gives me what figure, somebody? 33 33. Thank you very much. Dollars 33, like that. Thank you. Thank you. Great. Now, I would want to give you one last question. That illustration 3. I hope you are able to see illustration number 3. Illustration number 3. There were intercompany sales of $900 at a gross profit markup, a bad thing for us in consolidation, that markup of 50%. Anytime I see markup, I must gross that thing up to get margin. At the year end, the buying group company, which is the subsidiary, had sold on 150 of these goods. The parent has an 80% interest in the subsidiary. So required, they want us to get the POPs and they show the accounting entries. Could you kindly help me do that in a minute? So I can summarize this for you on the board. So we have the parents, we have the parent, we have the parent, we have the parent, we have the subsidiary, the intra-sales are 900. Profit markup is 50%. Profit markup is 50%. Profit markup is 50%. Right? And then there is a 150 there. So I would want you to use the information given. You use the information given to give us the POPs, to give us the POPs, to give us the POPs, to give us the POPs. But remember, out of the 900 intra-sales, we had sold a few goods there. I'm waiting for an answer. Great. Okay. 250. Let's see. 250. Somebody tells me 250. So remember that the intra-sales at the end of the day was 900. But we had been able to dispose what percentage, not percentage, but how much as B, as this subsidiary, we were able, or rather whichever company there, was able to sell goods worth 100 what here? 50. So what is of concern to us is what is remaining unsold. Remember, if we sold to our subsidiary or the subsidiary sold to our parent and the parent was able to sell the same to third parties, then that profit has been realized. The profit which has not been realized is the profit of the goods that we sold to ourselves within the group, but are still with us in the group, the unsold intra-sales. So this unsold intra-sales I can see here is 700 what here is 750. The other thing, when you give me the markup, I'll come and give you the margin. When you give me the markup, I'll come and give you the margin. So the margin here will be 50 over 100 plus 50, which gives me 50 over 150 like that. And then now I'll come and remember the formula very first. Remember the formula for PAPS. The formula for PAPS, what do we have? It's unsold. Unsold intra-sales. Unsold intra-sales multiplied by the profit margin. Multiplied by the profit margin. Multiplied by the profit margin. Now, ladies and gentlemen, the moment you have that, now everything boils down to really something that is manageable. This will be 750 times the profit margin, or 50 over 150. 50 over 150 times 750. Please confirm to us that Janet was right with the 250. I hope this figure is correct. I hope this figure is correct. So 250 is our PAPS. And the moment we get our PAPS, what do we do? As a consultant, I'll be just required to remember the few simple things. Once I get the PAPS, I'm supposed to increase my cost of sales. And then, of course, deduct this 250 from my inventory, because as we speak, our inventories are overstated. Our inventories are overstated like that. Inventories are overstated like that. Great. So is there anybody who has any question or any contribution to make? Any contribution to make? Now, I want us to go to something very interesting as we come to the tail end of this particular session under this course. Remember, the course is Group Accounting Intermediate. We've got two courses under this Group Accounting IFRSs. We have Group Accounting Intermediate, and then we have Group Accounting, the Advanced. So as we come to the tail end of the Intermediate, I would want us to know how to develop income statements, consolidated income statement. So for us to be able to know how to calculate, or rather how to prepare consolidated income statements, I would want you to write up there a title, Consolidated Income Statements, Consolidated Income Statements, or consolidated profit and loss accounts, profit and loss statements. So what are we supposed to do when it comes to consolidating income statements? What I need to do is to understand very well the group structure. Once I have the group structure, especially we realize that in the group structure, we have a subsidiary. What are we supposed to do? We are supposed to take the figures of the parent, plus the figures of what here? The subsidiary, through what we call line by line. So line, if it's sales, you take sales of the parent plus sales of the subsidiary. Cost of sales of the parent plus cost of sales of what here? The subsidiary, line by line. But now there is something very important that you need to know. we need to always see whether this subsidiary was acquired, especially when it was acquired. I mean, if it was acquired at the middle of the year, we have to count the number of months that we stayed with this subsidiary. So if, for example, this subsidiary was ours in the reporting period, if this subsidiary was ours for only, say, 6 months, so what I'll be doing, I'll take the sales of the parent plus sales of the subsidiary times 6/12. So the subsidiary's parameters must be time prorated. We must time apportion. But remember, the time apportionment is only applicable whenever we held a subsidiary for fewer months, less than what year, less than 12 months in the reporting period. So you'll always get, I've done quite a lot on these groups. You'll get even these big companies always getting wrong a few things here and there, right? And that is why we have to be, if we are getting into this consultancy of IFRS, we must be at the top of our game in matters of IFRSs. Remember, IFRSs, they keep on changing often. We have to have those IFRS handbooks, working with them, getting time to study them. Whenever there is any change, you should be the first people to pick like that. So it will be very important. Later on, we'll be making some adjustments. But for now, I would want us to look at a simplified question. So we are told here Colombo is an 80% subsidiary of Sri Lanka. So meaning that Sri Lanka is the parent. Colombo is a subsidiary that was acquired several years ago. Then they have given us the statement of profit or loss for the parent and for Colombo, our subsidiary. So we are required to do something very simple here. We are required to prepare the consolidated statement of profit or loss for Sri Lanka, for the parent, for the group. Now, the most important thing you're supposed to know here is that when preparing the group statement of profit or loss, we do not need the standard 5 workings that we know so well from preparing the group statement of financial position. Remember the 5 workings, what we call the big 5. The lion, the biggest animal of them all, the lion, which in this case is working number 1, being the group structure. You get the group structure wrong, you get all your consolidations wrong. There are 2 workings that are always required. Working 1 will be familiar. It is always a good idea to prepare the group structure. And we will see that it is useful to also have working 2 to calculate the profit attributable to the NCI. So, ladies and gentlemen, let's begin with our group structure. Our group structure here really is nothing to worry us at all, because they have even given us Colombo is owned by Sri Lanka. 80% of Colombo is owned by Sri Lanka. So simply mention there group structure. So our group structure. So we have here group structure. So group structure, we have Sri Lanka. So Sri Lanka owns 80% of Colombo. So we have 80% of Colombo, and therefore Colombo is a subsidiary of Sri Lanka. Because of what here? Significant shareholding. Because of a shareholding which is more than 50%. So Colombo is a subsidiary of Sri Lanka. And remember, it doesn't own it 100%. It doesn't own it fully. It co-owns it with some other partners. The other partners, in this case here, so the group share holding The group share here is 80%. Then we have a smaller group called the NCI. NCI is non-controlling interest, which has got 20 what here? 20%, which has got 20%. NCI is the non-controlling interest, which has got 20%. Once I have that right, then now I'm okay to go. I'm okay to go. I don't even need to go to the other working first. What I'll do is to write there the name of the parent, the name of the parent. So the name of the parent is Sri Lanka. So Sri Lanka Group, Sri Lanka Group, Lanka Group, consolidated statement of profit, consolidated statement of profit stroke loss for the period ending. They haven't given us the year, no problem. So from there, we'll start straight away with our consolidations. Given that in the group structure, we have a subsidiary. When we talk of sales, consolidated sales, we are putting the sales of the group members together. We are adding them line by line. So I'll have to fix my question here. So we have like revenue, Sri Lanka is 200, Colombo is 100. So sales revenue, either you call this sales or revenue, one that's the same, or you can even call these sales revenue, sales revenue. So sales revenue, what do we have? We have the Sri Lanka is 200, Colombo 100. So 200 plus 100. So here I will not be doing any time apportionment. Why? Because we are told that Colombo was acquired several years ago, meaning that Colombo was our subsidiary for all the months of the reporting period. So if you want to do any time apportionment, then what you'll be doing in the reporting period, then what you shall be doing in the report, you'll be saying that in the reporting period, this Colombo was ours for 12 out of how many months? 12 months. It don't make any sense. It won't make any sense. If we acquired this thing several years ago, it means that in the reporting period that has got 12 months, Colombo was our subsidiary for all that year, for all those months. So there is nothing like time proration. There is nothing like time proration. So leave the time proration outside there. From there, we have the cost of sales. Cost of sales. So from there, we have the cost of sales. So the same thing, cost of sales, what they want us is to consolidate, to put together, we have 150 and 60. 150 and 60. 150 and 60. And then, of course, now we will leave the space for gross profit. The space for gross profit. So you can see 200 plus. Here, there are no adjustments. In my next class, of course, I'm left with 2 classes. You're going to see, we shall be introducing these intra-sales. We shall be introducing the PAPs. Here, I simply want us to have a simple example where we are basically putting things together. We were putting things together to show us the concept of what here? Consolidation. So this gives us 300. This gives us 300. This gives us 150 plus 60. This gives us 210. So when you subtract, we should be able to get our gross profit of 90. We should be able to get our gross profit of 90 like that. So from there, now we need to look at the expenses side. So the expenses side, what do we have in the expenses side? The expenses side, we have the operating costs. So operating costs, ladies and gentlemen, what I'm simply doing is to put together. To consolidate is to put together. So operating costs, we have 10 and 25. So we have here 10 plus 25, which gives me 35. So I need to come and do what here? Subtract. So 90 minus 35, that gives me what here? Somebody, is it 55? Yes, that gives me 55. So this 55 is what we call what here? Profit before tax. This is what we call the profit before taxation. The profit before taxation. This is what we call the profit before taxation. Profit before taxation. Once you have the profit before tax, go ahead and share this with your taxman. So we have here less tax. So the tax also has to be consolidated. The tax has to be consolidated. The tax has to be consolidated. The tax has to be consolidated. So the tax consolidated, putting them together, I can see 12 and what? 5. So we have here 12. We have here 12 and 5. So we have 12 plus 5. So 12 plus 5, that gives me 17. 12 plus 5, that gives me 17. 12 plus 5, that gives me 17, like that. So please go ahead and subtract this for me. I would want someone to give me this figure. This is what we call the profit after what year? Profit after taxation. Profit after tax, profit after tax, profit after tax. Can somebody give me that figure? The profit after tax. Sol gives me 38. Thank you very much. 38. So this profit after tax of 38, we need to share this profit after tax out. We need to share this out. We'll say attributed to the owners, of which we have got 2 owners of this group. We have the parent, and then we have NCI, the non-controlling interest, the parent and NCI. So remember the profit after tax, you can even come and double underline. Profit after tax, you can come and double underline, and then you will come and say that this profit after tax, who are the owners? 2 of them attributed to the parent, and then number 2 attributed to NCI. So listen, remember the 2 must come and account for what here? The 38. The 2 must account for this 38 is what I'll bring here. Now listen. When you look at Colombo is the one that we are sharing their profits. Its profits here, this 10. The profit for the year, the 10. The 10 is what we are sharing out. Is what is being shared out by who? By the parent and the NCI. And then I know for sure that NCI will be taking 20% of Colombo's profit. I'm repeating this again, that NCI is taking 20% of these 10, 20% because the subsidiary has 80%. The parent has 80%. So we are sharing Colombo's profit of these 10. Now listen and listen and listen and listen. We are saying that NCI are taking 20% of the subsidiary's profit, which is 10. So 20% of 10 gives me what here? Somebody gives me 2. 20% of 10 gives me 2. And then now the balance goes to the parent. The balance goes to the parent. So we have here 38 minus 2. 38 minus 2 gives me what here? Somebody gives me 36, like that. And now that makes the end of this. Thank you very much, Sol. That marks the end of our particular question. The first question is a little bit simplified, for you to follow. But after you've understood this general concept of how to prepare consolidated income statement, it doesn't matter what complications they'll be bringing in later on. Ours will basically be to adjust using this general what here? Structure, using the general structure. So ladies and gentlemen, that as well marks the end of our today's session. Great. It has been an honor and a pleasure to host you this morning. I want to believe you have gotten something out of this, however small. And how I hope that as the Arrow community, we need to basically introduce these internal trainings, like for everybody, even if it's 30 minutes. If you look at these global leaders, like in IFRSs, like the big four PwC, they have internal training managers who basically are able to take all these people, the staff of those companies, through this kind of trainings. So training manager internal is also able to bring other people from outside to train, because really we have to develop this competence from within. I know it's not one of the academy's objective to train people internally, but I strongly believe, given the kind of hassles we go through, with the managers, Paris and the others, Janet, etc., where a case is thrown to us, we discuss it as managers, and then we say we don't have somebody who can handle this internally. I strongly believe it's a problem of what here, internal trainings. What do you think of that suggestion? What can we do to ensure that we really build up a very great asset from within here now that we want to be known globally as an IFRS consultant organization? It's a general discussion. Remember, I could be wrong. Just mute and say you are telling us bad things.
Internal training is really important, Joshua.
It's very important, yes.
Very important.
Uh-huh.
I have one question.
Yes.
Is this the final session or is it another
No.
one? How many
We've
sessions?
done 3 hours.
Yeah?
We have done 3 lessons, 3 hours. We are left with 2 more.
Okay.
Yes.
What is the topic on those sessions?
The last 2 sessions I'll still be talking over income statement, but now this time around I'll be using Excel, not whiteboard.
Okay.
Joshua, where can we find the recordings of the sessions? I think I missed the 2 previous ones, and I'm going on leave, so I won't be available for the next.
Unfortunately, the first 2 are not recorded, but I can do them afresh. And then through Emily's help, we can put them in Landfire for the internal consumption.
Okay, thank you.
Okay, great. Any other suggestion or contribution before we wind up? Frederick, thank you very much. I've seen you. Do you have anything to tell us? Okay, so have a good day. Bye-bye.
You too.
Okay.
Thank you. Bye.
Okay.
Thank you.